If you want to be a successful crypto trader, you need to know these chart patterns. This is going to be a crash course on the fundamentals of crypto trading, and if you're able to master these, you're already better than 90% of the crypto investors out there. This is what we'll be going through today, and it can basically be broken down into three categories. The first two rows is what I refer to as triangles, and the third row is essentially rectangles, that's my personal terminology, and the last row are essentially candle patterns. There might look like a lot of information on this particular page, but I guarantee you by the end of this video, you'll be seeing these patterns as if you've got a third eye. There is one thing you guys need to know when you're doing trading, and that is when the price breaks out, you can typically go either way. Despite the fact that we've got bullish pattern and bearish pattern labeled in these charts, these are just slightly higher probabilities of the pattern being bullish or bearish, and it is not a guarantee. These are increased probabilities, but they are not guarantees. Now let's move on. So the first one are triangles, and these are the most frequent pattern that you'll encounter during your everyday crypto trading. I'm not going to go through each in detail, but I'm just going to go through around two examples, and they are fundamentally the same in terms of how you trade them and how they will play out. So the first one is ascending triangle, and on the top we have this red line. This is what we call a resistance / level of significance, and on the bottom on the ascending red line is what we call support. So when we see this particular pattern happening, we want to enter the trade when the price of the particular crypto asset we're watching goes above the red line, and that is our resistance level. And we want to sell, we no longer want to be in this position in two instances. If the price comes back down below this support level or below the leg before the leg run up, so the price where my cursor is currently at. So if the price moves back down below this red line, that means our pattern has failed and you will not be realized. This is where we cut our losses and move on because this pattern is no longer valid. And now to give you guys an example, so over here we have the Ethereum USTD on the 1-day time frame chart. So we're looking at around the period of June the 1st to around the end of July. So what we have here is a pretty evident ascending triangle. So we have a lot of overhead resistance levels here that is respected as per our auto and support resistance level. And we can see a bit of an ascending lows and ascending triangle formation here. And it is a bit more evident here because we can technically extend our support level a bit further over here as well, and certainly into this particular point. And we can still use the overhead resistance level, but for the sake of this example, we just want to look at the price locally. So we are seeing the price basically move like this. And as per our example over here, we want to buy Ethereum when the price of Ethereum moves above the red line. So in this case, we want to buy Ethereum at this particular price, which is around $252, $253. And what we've seen after in terms of the price is what we call a breakout. And if we have a look, Ethereum then saw a massive run of approximately 93% from this particular play. Now, had the price of Ethereum for some reason, let's say went up here and then come back down, once the price falls below around $250 or $248, depending on where your stop losses are. So let's say in the first instance, we are looking at this stop loss, which is this very first level here. If for some reason, if the price of Ethereum came below $250, you want to sell because you want to cut your losses. The other stop loss is around this particular point, around $230, $228. If the price of Ethereum moves below this particular level here, you also want to stop out. Now, before we continue, I'd just like to share with you guys that you can support your favorite crypto projects with physical crypto tokens from Minted Crypto USA. These coins are incredibly high quality and will show that you have been a loyal supporter from day one. These are fantastic to have as a collection and make perfect gifts for your friends who are also into crypto. Minted Crypto USA ships from the US and you'll be able to receive your physical token within the week. Get yours today and flex it to your friends and family when your crypto takes off. Link in the description. And essentially all of the triangle patterns more or less look the same. So we have another one here. This is the bull flag, which is number 4 on our cheat sheet. So technically we have a bit of something like this if we draw it up. So for example, in this instance, if the price of Ethereum went above around $400 or because we have a resistance line here When above $408, $410, we technically want to enter here, which is at this particular point. And if the price of Ethereum, let's say in this case, fell below this particular point, around $375, we no longer want to be in this position because that has failed our pattern. And that's essentially the number 4 pattern explained. There are also some additional notes that you can read on the cheat sheet as well. You can find the cheat sheet in the description below. The next set of patterns I would like to call the rectangular patterns, and this is just my personal preference for a name because I sort of visualize a rectangle on my screen to be able to see these patterns easier. Now, there are essentially 2 categories here. There is the double top, double bottom, and a head and shoulders and inverted head and shoulders. So I'm going to use the double top for the example here because it's just a bit easier to visualize with a lot of traders. So we have the price coming back down, it hits a particular support level, then the price bounces back up. And in this case, the price came back down again and respects the very same support level. When we see this happen, we want to buy this particular crypto asset because we anticipate that the price of this crypto asset is going to go up. And this is also very, very similar to the inverted head and shoulders. There are 2 big differences here. The first big difference is that the support level here is actually violated. So the price came below the support level before coming back up. And the second distinction is actually more of a personal one. So there are traders that I know that will personally enter at the particular point here and capture the same movement back up like we've seen with the double bottom. However, in my personal experience, this does not always happen, and I'm a bit of a safer trader, and I will only like to buy once the price overcomes the resistance level that we've seen tested before. And to show you guys an example, we have Ethereum on the 1-day time frame. This is around the 23rd of June to around the 23rd of July. So over here, we can see there are a number of support levels that have been respected and tested before. So we draw this particular support level here. And over here, we have the previous resistance level that it failed to overcome. So let's just draw that here. And we can see the price coming from above like we have seen in this particular image. So once the price comes down, it has the support level, it bounces back up, it couldn't make it past this particular point, and it comes back down again. And at this point, because we've seen the levels being respected before, we want to enter at this particular point just a little bit above the support level. So this is around the $1,750 level. And if you buy Ethereum around this point, around the 1750 mark, you'll first see the first leg of the move, which is around 30%, and then we see a second leg of the move, which is around 80%. And if for some reason the price went like this and came back down, you no longer want to have your Ethereum. You want to sell your Ethereum at roughly the 1685 or the 1680 level because this pattern is no longer respected. And the last one are candle patterns. These are incredibly easy to spot, and I've given you 4 examples of these. There are lots more, but I think these are a much more rare occurrence compared to the basic overall patterns that we've seen above. Now, one thing to keep in mind is that the more people that see these patterns, the more likelihood that they will come to fruition. So going through this quickly, the hammer candle is essentially the price opening in the upper quartile and closing at the very top. So we open here, the price came down and immediately went back up and closing at the very top of the candle. The shooting star is the opposite. The bullish engulfing and the bearish engulfing are essentially big candles where the body of the candle encompasses and covers and eats up the previous candle, but the direction of the price is opposite. So in this case, the red candle here indicates that the price went down, and immediately the very second candle has a huge body that engulfs the entire previous red candle. And like I said before, the bigger patterns, especially the triangular patterns, are typically easier to spot on a graph because what a lot of people do is they tend to zoom out. So as a result, it is a bit more difficult to see the smaller candle patterns. Anyway, that is all. These are the very basic fundamentals that kickstarted my career as a crypto trader. And if you're also a trader or an investor, let me know in the comments what your favorite pattern to trade is. I will read every one of your comments. As always, take care and we'll catch you guys next time.